Have you ever wondered what the stock market really is? Why do some people like Warren Buffett turn it into a machine that builds generational wealth? His stock market return is over 55,000 times, while others treat it like a casino and lose almost everything. The difference is not luck. It is not connections. It is not even intelligence. It is knowledge. And that is exactly what we are going to give you today. By the end of this video, you will understand how the stock market works, how people actually make money from it, and the exact steps you need to start investing with confidence. Even if you are starting with just $50, we will cover why you should invest, how much you can realistically make, key terms you need to know, how to build your first portfolio, and how to place your first trade. Let us start from the very beginning. Part 1. Why you should invest. Why should you even bother? The S&P 500, which tracks the top 500 companies in the United States, has produced an average annualized return of around 8 to 10% per year historically. Stocks have outperformed every other major asset class over the past 100 years. Better than bonds, better than gold, better than real estate. The third reason is compound interest. You invest $1,000. You earn 10% in year 1 and end up with $1,100. In year 2, you earn 10% on $1,100, not the original $1,000. By year 20, that $1,000 has grown to over $6,700. You added nothing. Time did all the work. The fourth reason is inflation. A savings account pays you 0.05 to 0.5% per year. Inflation runs at 2 to 4%. Your money sitting still is quietly losing purchasing power every single year. Investing is how you protect yourself from that. Part 2. How much money can you actually make? The answer depends on 3 things: how much you invest, how consistently, and how long you stay invested. Here is a real example. You have $1,000 a month to invest and $5,000 saved as a starting deposit. You invest consistently at an 8% average annual return for 30 years. Your ending portfolio balance will be over $1.5 million. Your total money invested was $365,000. Your profit from compounding alone is over $1 million. Some years the market will be down. In 2022, it fell 18%. In 2023, it was up 20%. In 2024, it was up 25%. On average, 8% is the realistic long-term expectation. And here is the most important thing you will hear in this video. Time in the market beats timing the market. Investors who simply keep buying every month, regardless of conditions, consistently outperform those trying to find the perfect moment. Just keep buying, market high or market low. Just keep going. Part 3. Stock market terminology. Let us cover the key terms you need to know. Stocks are small pieces of ownership in a company. Companies sell shares to the public through an IPO, initial public offering, to raise money for growth. Bull versus bear. Bullish means you expect prices to rise. Bearish means you expect prices to fall. A bull's horns point up. A bear's claws swipe down. Market cap is the total value of a company. Large cap companies are worth over $10 billion and are generally stable. Small cap companies worth under $2 billion tend to be more volatile but with higher growth potential. Index. The S&P 500 tracks 500 large U.S. companies. The NASDAQ focuses on technology. The Dow Jones tracks 30 major companies. When people say the market went up, they are usually referring to one of these. Blue chip stocks are the premium stable companies. Apple, Microsoft, Coca-Cola, McDonald's, large, established, long track record. Dividends are a share of company profits paid directly to shareholders every quarter just for owning the stock. P/E ratio tells you how much investors pay for every $1 of a company's profit. Apple's P/E is around 38. Nvidia's is around 53 because the market is pricing in massive future growth from AI chips. Always compare P/E ratios within the same industry. Part 4. How to build your first portfolio. 2 main approaches. Individual stocks. You pick specific companies directly. Nvidia picked a few years ago would have been extraordinary. Intel bought at its peak in 2000 still has not recovered today. Individual stocks require serious research and carry real risk. If you go this route, diversify across sectors. Never put everything into one industry. Index funds. This is where most beginners should start. An index fund buys a tiny piece of every company in a given index automatically. One purchase gives you instant exposure to hundreds of companies. A fund like VOO from Vanguard tracks the S&P 500 and charges just 0.03% per year in fees. The three-fund portfolio is what most experts recommend for beginners. 60% in a U.S. stock index fund, 30% in an international index fund, 10% in bonds. 3 funds, fully diversified, low cost, set it and forget it. Part 5. Opening your account and placing your first trade. You cannot buy stocks through your bank account. You need a brokerage account. The best beginner platforms are Fidelity, Robinhood, or M1 Finance. All free, all beginner-friendly. All support fractional shares, so you can invest $50 even if one share costs $500. But before you open any account, here is the most important decision you will make. Open a Roth IRA first. With a Roth IRA, you invest money you have already paid taxes on. Everything inside grows completely tax-free. Every gain, every dividend, every dollar of growth. 0 taxes when you take it out. In a regular brokerage account, you could owe 15 to 20% capital gains tax on your profits. On $2 million, that is $400,000 to the government. In a Roth IRA, you keep every single dollar. The annual contribution limit is $7,000 as of 2025. Once your account is open, placing your first trade is simple. Search for VOO, click Buy, enter how much you want to invest, select Market Order, click Confirm. That is it. You are now an investor. The one habit that separates investors who build wealth from those who do not. Once you invest, your most important job is to not react. In March 2020, the market fell 34% in just over a month. Every headline said the world was ending. Investors who held on recovered everything within a year and went on to significant gains. Investors who panicked and sold, locked in their losses and missed the entire recovery. Set up automatic monthly contributions. Treat it like a bill you pay yourself. Check it quarterly at most. Do not let headlines make your decisions. Warren Buffett did not build a 55,000 times return by reacting to market movements. He built it by buying quality and holding for decades. You do not need to be Warren Buffett. You just need to be consistent, patient, and informed. And now you are. If you want to learn more about investment and want to protect your money, subscribe to the channel and like this video. See you in the next one.